Hello, everybody. My name is Lee Schwartz, and I'd like to welcome you to our virtual business discussion. Today's topic is economic indicators for business. You know, even in normal times, SVA tries to keep our clients and really the entire business community educated on important items and changing legislation and what effect it might have. But obviously, the last 6 months, we've been holding webinars fast and furious. And while we were focused at the beginning on the PPP loan and getting through this unprecedented time, we've really shifted to making sure you all have the tools to look forward and help you make the best decisions for your organization. Now we'll jump in here in a sec, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat function within Zoom and submit your question to all panelists. We are going to leave plenty of time at the end for Q&A. Also, we are recording this webinar today. If you'd like to watch it, you'll receive an email with a link to a survey, as well as our SVA resource page where the webinar recording will be available. Now, from peeking at the attendee list, we've got a large and a very diverse group of organizations on here. So we're going to try to look at this from a few different angles. Many of you are already clients of SVA, and we encourage you to reach out to your SVA contact if you have questions coming out of this. But if you're not a client and you have questions, please reach out to me and I will get you connected to a subject matter expert at SVA who can help. So today we brought in a great team to help you look at market trends, help contextualize them, and learn about leading indicators and how they might affect your business or organization. If you've been on any of our webinars recently, you're already familiar with him, but Dan Glomsky, for you first-timers, is a CPA, an ABV, a CVA, an MST, and a principal with an SVA certified public accountants. He's got the whole alphabet soup. We've also brought in two members of the investment committee from SVA Financial Group. Rob Cummesford is a chartered financial analyst and a senior portfolio manager. And Tim O'Brien is an MBA, also a chartered financial analyst, and the principal and the director of research with SVA Wealth Management. I am gonna let Tim take it from here. Go ahead, Tim.
Thanks, Lee. So we're excited to be here. This is the stuff that we really like to talk about, we get excited about, but Lee didn't give you the warning. The warning is there's going to be a lot of charts and graphs to follow on national, regional, state, and even some local levels. So be ready for a lot of nerd talk because you got three nerds up here with you. And we're really going to start at the biggest picture, which is looking at the US economy, which obviously took a huge hit in the first quarter. And one of the best ways that we look at, and probably the first way most economists look at, is at GDP, gross domestic product, which is really the monetary value of all finished goods and services. The classic definition is consumption plus investment plus government net exports. And if you look down in the bottom left, down around 2010, 2011, that was around 15.6 trillion. We had this really nice steady climb, up until the end of this last year where we went over 19 trillion. And then COVID hit and we really took a big hit. One of the ways we want to look at it though is look at the different sectors and how the different parts of GDP were actually hit. This chart shows the 5 previous quarters, and it shows the blue line as what overall total GDP was, and then we break it down into private goods, private services, and government. And you can see kind of the quarters going into this that we were pretty steady. We were doing, fairly good right around that 2%, but in the first quarter we took a big hit, and you can see from the circle, the biggest piece that was hit was the service area. So think about restaurants and travel, and really those service pieces took a much bigger hit than either the government or the goods part of it. And even different states really saw how it was affected differently. The average was down 5%, and you can see Wisconsin was right on that average. But some areas where it hurt a lot harder, you see New York was down over 8%, Nevada with all the casinos and entertainment was down 8%. And then some of the more agricultural areas weren't hit as bad. So kind of that Dark blue was bad, but not as bad as some of the other areas. And the lighter the color it got, the worse it was. So we were really kind of in that middle of what happened. One of the things that we tend to look at as a signal is the leading economic indicators. And leading economic indicators are 10 different areas that get measured and put together. And when they're green, as you see here, the green means that the economy is growing. When they go red, it means that the economy is getting ready to shrink. And usually, leading economic indicators tend to give you a few months warning about, hey, things are going to turn bad. This time, though, this was a pretty big shot out of the dark, not really out of the dark, but sudden. And so they really coincided, so they weren't nearly as good a leading indicator as we might have hoped. So we didn't get that much warning on that part of it. What you have seen, though, since then is we wanted to take a look at, what have we seen any recovery since that part of it? So on the next slide, we look at the Purchasing Managers Index. And they have two areas. They look at manufacturing and services. And what this is, it's a monthly survey of over 400 purchasing managers. And they're in 19 different industries. And they're asked a series of questions on how they think things are looking going forward. 50 is the line. So if you're below 50, then they believe that things are shrinking. If they're above 50, then they think that things are improving. And you can see on manufacturing that you really had a steady slowdown, if you will, from even 2018 and even dropped below that 50 number even before the COVID virus had hit. But since then, you've had a really big positive in this last quarter move up to 56%, which is saying, hey, the guys that are out there or the folks that are out there buying things or managing part of the supply chain, they see things are improving. You also saw that in the service area, which I think is impressive too. But if you look at kind of our purchasing, how we purchase things on the next slide, really our economy, another way that we look at it is like, okay, how much of the economy is based on the purchases of goods? And that's about 28%. It's the V on the bottom. How much of it is based on services? And it's the big 42% of it. So we are really a consumer-based economy, and we're really driven a lot by services. So how do these two things react, really in the last few months? So you saw from the GDP numbers that we saw both areas really go down. So if you look at the chart on the right here, you can see that the orange line is services and the lighter line is goods. And if you were purchasing $100 of each of them in January of 19, by about January of 20, you were buying about $103 worth. Well, then they both really dropped. And then you drop down to where your spending on services was down about 84, 83 cents. And your buying on goods went down to 90%. But on the recovery, although they both have recovered some, you can really see the difference in the recovery in goods. So we're up actually over that. So people are buying things. If you go try to buy a bike or a kayak or something that you might use in COVID, those numbers are really hard. Inventory is really low. That area is working well. You don't see the same thing in services. Another leading indicator, one of the leading indicators that we think you can see is in transportations and rails. And again, you can see kind of that slowdown here from 18 and 19 as it rolled over, but a real V recovery as you've seen this move. You're also seeing it on ports. So a lot of different seaports are really at capacity as goods are really starting to flow through there. Another specific example on that would be on autos, autos are up over 6% nationally right now. And you can see again, the bottom fell off on autos. We were doing around 16, 17 million auto sales a year, dropped down to around 9. August, it was back up around 15. And again, if you look at Wisconsin, we're kind of right there in the middle. We're up 5%. So you're seeing people willing to go out and spend on hard goods. You can't say the same thing on services. And an example of this that I think is pretty telling is taking a look at hotel occupancy. So the red line is this year. The blue line is the medium or the average from 2000 to 2018. And you can see the slowdown in 2009 was the black line. So you've seen this bottom down around this year around 20%, back up around 50%. And we really think this is kind of that swoosh or that leveling off. So again, where you saw goods, more of a V recovery, we're now kind of at the point where we'll show some other slides, and Rob will really talk about it when he talks about the COVID, what we're tracking on that. But really to get capacity up higher, our feeling is you're probably going to need some help with a vaccine or some sort of solution around that area. So services are an area where we're showing some continued concern. You see it in a couple other areas that we follow. So credit cards, for example, and this is just one of the sleeves that we look at on the left-hand side is retail and food. And you can see what's happened. You know, it dropped way down and now it's back up to kind of that break even. Again, foot traffic, when you take a look at casinos, restaurants, groceries, stores, you can see that big drop. And again, a leveling off more in that service area. And a lot of that's been, has had some other effects on consumer behavior. And one of the big ones is savings rates. So we talked about earlier, and I know Dan's been on different panels talking about the PPP loans, and so has Lee. But what happened on the basic consumer is that we were saving, which is actually fairly good since the Great Recession, around this 5, 6, 7% level. But when the COVID virus and the economy started to shut down, the savings rate jumped all the way up to 35%. So the government was pushing money in, PPP loans were coming out, but that money was just getting put under a mattress that wasn't getting used. And the opposite of some of those other charts, though, now you see that as this rate has come down, people are starting to spend on that, but they still have a pretty good sized cushion. We would contend that could be a real positive going forward as the consumer decides to spend, especially on those services area. So that could be a big benefit going forward. One of the big areas besides services and goods is housing. And we think that housing, carries a lot of weight, a lot more weight than you think, especially when it comes to job creation and where that goes. But you can see this really shows new homes by region. And you can see the South has been where a lot of the new home construction is gone. And you can see at the very right of the chart that all the areas had a really turned down, but now they've kicked back up again and are actually kind of through their highs from back in the 2008, 2009 slowdown. There's some really good, powerful economic things behind that. You've got this group of people that are graduating from college in their 20s and their 30s who haven't bought a home yet, and you're starting to see that group really start to look for home ownership. So we think there's some powerful long-term economic trends that can help this. If you go to the next slide, it also can see that it's true also in Wisconsin. So this is new private home units authorized. So it's permits in Wisconsin. And you can see towards the end of 2019, we were pretty high. We were at a high of over 2,000, 2,200, dropped down to just over 1,000. And now we're surging back up again. So the same really holds true in Wisconsin as it does across the country in housing. The area that we're most concerned about and the area that we're, so I have one other piece of it is, this is why housing is so important. Housing and manufacturing, and Dan and I and Rob were talking about this a little bit before the call, is that especially if you think about the areas around Milwaukee and even the broader Midwest where manufacturing is really improved, for every manufacturing job you have, it creates 7.44 new jobs. And for every construction job there is on our home building job, they call it real estate in this part, is over 8 new jobs. So you can see in these areas, you want jobs in these areas because it has a virtual effect of creating more jobs as you go. So we think it's very important that you have a strong housing market, and that also if you can have a strong manufacturing can really help. The area that has not recovered is U.S. employment. This shows going back to 18, we were having steadily improving employment. We were over 150 million, and it fell down to like 130, and now we're back up, but not nearly recovered as much as we would hope, and really one of the keys going forward. The same, again, employment in Wisconsin has not recovered either. So, we're at that 3 million, we dropped down, and there's a set of jobs that we're hoping won't be permanently lost, but the longer that we go on in this environment that we're in, the more we're concerned that more and more of these jobs can be found in permanent in loss. And if you look regionally, if you look at the Milwaukee area, for example, on the left-hand side, it shows where the U.S. employment was and where Milwaukee's was, and you can see almost right on the same as the U.S. So Milwaukee has really felt the same pain as the U.S. But one of the interesting things when you dig down in the numbers, the hardest hit area was leisure and hospitality, down 24% or 21,000 jobs. But if you look at the next biggest area that was hit with over 12,000 jobs lost is manufacturing. You go back and think about that job multiplier. Those are jobs that you don't want to lose in particular. In the Madison area is a little different. Again, when the panelists were discussing earlier, two cities that aren't that far apart, but really have really different drivers. And we could throw this up on a bunch of different other regions in the state even, and you'd have different feelings. But the big area here was leisure and hospitality, which was down 38% and over 15,000 jobs. And then Madison lost a bunch of government jobs with over 19%. So, and you can also see that Madison has been hit a little harder and has not caught back up to the average on the chart on the left. The other kind of way to view it is, what has happened to unemployment. And I remember back in the Great Recession in 2009, and we hit 10%. And I thought, boy, it's going to be hard to ever top that. And then you saw this kind of nice slope down on the dark line to where we got to under 5%. So, and the blue line below that is wage growth. And you started to, from 12, you actually started to get some nice wage growth. And then you end up with this spike, which was over 14%. Now it's back to 8. So you're seeing some pullback. But again, we'll go back to, where do we think we need to see improvement? And we really think we need to see that in those service-driven jobs. Next slide. The kind of what we're looking at, kind of, if you look into the different areas, again, without an improvement in capacity, it's hard to see retailers, restaurants, the recreation and air travel. So we would likely see some weakening in those areas. That level shows that it's 16.5 million jobs. The area that you're seeing strength, which can kind of maybe get us through this period, is you're seeing some really nice growth in manufacturing, healthcare, technology, and that's a much bigger area, 47 million jobs. So we think that you could see some real continued growth in that area also. Kind of one of the underlying hidden things that we think it's hard to measure, but you are seeing really productivity increases. And it's going to be really interesting to see whether the people that did move home, like a bunch of us did, and working out of their homes, are we going to see another spike in productivity increase? But this steady increase means that we're getting more out of each worker too, and that's going to help drive overall economic activity. So that's a real plus, and the people that we work with think that that number is even going to be higher at 2.8%. So see that number starting to continue to increase. And we said earlier that you really need to be the U.S. is a consumer-driven country, and you really need to have the confidence in the consumer to go out there and spend. And we saw what happened in that savings slide that we showed earlier. You're starting to see confidence on this left-hand chart, move forward. I do like this cartoon on the right, throw another billion at it, and that guy's on his shoulder says the Fed. So if you think about what the Fed's done, right, is they've tossed all this money at everybody and nobody's spending it. So the velocity of money, the money that's getting out and circulating, is actually one of my favorite slides, but we didn't have it in this deck, is not moving around. That has two big issues out there. First off, it doesn't help the economy, but it starts to build up this big bucket of inflation possibility when that money might get out later on and get out into the economy. We also, CNN has this really cool index. It's called the Fear Greed Index. And right now we're right in the middle. If you look at the chart on the right, it shows you the lows and highs. And I think the interesting thing is that every year you get extreme fear and every year you get extreme greed at different points. And if you just bought low when there was extreme fear and sold when there was extreme greed, you would probably be in fairly good shape. But it goes again to the confidence of the consumer and where they are, or in my opinion, the overconfidence or the underconfidence, if you will, if they're on one way or the other. So one of the big things is I think we're all pretty good at taking a look at when the world is normal, how you interpret and how you read these different economic indicators. A bigger area is how do you do these things? How do you read these? What do you do when things aren't normal, right? So what do you do in the middle one there when 9/11 hits? How do things recover? You saw hotels actually recovered fairly quickly, if you remember back to that graph. How do you recover if it's Hurricane Andrew or the fires that are going out in California or the devastation that you saw in the Midwest, in particular Iowa, where I grew up. So how do you deal with those things, and how do you build those into your models? And obviously, we think the biggest one right now that you have to watch is the reaction to the COVID virus and how we're going to tackle that. And Rob is going to cover a few things on that, and then some more detailed slides on some other things that we look at in the economy.
All right, thanks, Tim. So yeah, what Tim just discussed on the previous slide was really, what the markets react to is uncertainty, and what the market doesn't like is uncertainty. So COVID certainly was an uncertainty or a black swan event, you might hear that term, that really hit home this year. So here we see, sort of the good news is we've seen some of these numbers trickling down over time. A lot of conflicting reports on specific state issues and so on, but overall we're starting to see some of the peak numbers, as you can see, roll down the curve, which is good news. Hopefully we're moving through this pattern and we don't see a resurgence to the prior peak type levels. But all of this has really had an impact on the healthcare system, and you can see that how hospitals have responded. As they transitioned to this new COVID world, a lot of routine procedures and other things were delayed as they prepared for an onslaught of COVID treatments and had to change over to incubators and other equipment. And so what that led to was a decline in a lot of their normal routine procedural revenue base and so forth. And they've ended up laying off staff, to many people's surprise. How can that be when we need all these healthcare professionals to deal with COVID? It's the nature of how do we pay for these professionals if we don't have the other income generating activities going on? So the hospital statistics, on occupancy and other things are also well below where they were previously due to trying to deal with this COVID situation. And, anecdotally, a friend of ours, doctor in the UW system, had just switched over to UW from another healthcare system. She was dealing with the COVID and how they were preparing for it. And in many cases, they didn't see the extreme cases here in Madison anyways, that they saw in other parts of the country. And they were prepared for all these patients. And many times they only had maybe 2 patients that they were treating in their entire hospital for COVID-related, severe cases of COVID-related treatment needs. So that was the unfortunate reality that led to some of those layoffs I just discussed. So, the other good news that some of the market reaction you're seeing is, future work on the treatments for this, a vaccine for COVID. And there's a long road to this. Obviously, we've got a lot of drugs that are in different stages of testing and trials. We've got a few that are really have been sort of accelerated and are closer for that early or limited use approval, but none have actually been approved yet and been put into actual distribution. And so that is still that uncertainty that's out there on treating COVID. Is how long are we looking at? Is this going to be several months? Is it going to be another year or longer, and so on? So a lot to be determined there. And that is exactly what the market reacted to as we look through the next few slides that go and deal with, stocks, bonds, and other areas. So here we see, how the stock market reacted to this in early March. This is actually a 5-year chart going back. And you can see, in the first couple of months of the year, it was pretty much business as usual. We had heard about some disease in China at the end of last year, December or so. News started trickling about an outbreak in Wuhan province, and that this was under control, it appeared. And then suddenly it wasn't under control, and we've been living with it ever since. And you can see how the market reacted with that sharp drop in that March time period. But, surprisingly to many, me included, is how we have been able to recover from this. Some of the economic statistics that Tim went over, have show that resurgence in economic activity, and that's part of what the stock market as a leading indicator is trying to price in. But there still is a lot to be determined as far as the longer term impacts of some of this. But in general, with all of the Federal Reserve's activity, with all of the fiscal stimulus measures that were put in place, particularly in the US, that led to a very strong backdrop for stocks, and they have since returned and actually surpassed the prior record levels that we were at toward the start of the year. On the next slide, we look at how the interest rate environment has been impacted, and it's a very different story. So here, we were already in a declining interest rate environment. This chart shows the 10-year US Treasury yield, and that actually peaked out back in about 2018 or so, and we've been declining ever since. So as we hit March, you can see how the yields quickly dropped off as markets reacted to that uncertainty again, both in the stock market and in the bond market. And the Federal Reserve actually had to step in and institute a wide variety of quantitative easing measures to really shore up the confidence in the bond market and provide much needed liquidity to ensure that transactions could still be completed as usual. And they stepped in and started doing a variety of buying programs. Now, what those buying programs have done, and this is across both, treasuries, mortgages, corporate bonds, and so on, basically many parts of the bond market. And what that has done is essentially created sort of a ceiling on yields. And we've seen it as they've stepped in to buy, that has continued to suppress the yields that are available in the marketplace for fixed income investments. Other areas that were impacted were the energy markets. So what have we seen as people have been required to stay home for extended periods of time? We have not seen a resurgence in oil prices, in gasoline prices at the pump. This again shows the last 5 years, and we really haven't moved a whole lot, but we've declined actually from where we were previously because people just aren't driving as much, at least here in the US. But globally, demand is also down, and the International Energy Agency, IEA, recently just dropped their longer term forecast for oil demand again because of the impacts of COVID. Now, what you actually, there's a little bit of anomaly here. I just want to point out around that April timeframe where we show a almost negative $40 price on oil. That was a short-term disruption where futures contracts were coming due. And essentially there was no storage here in the US. So if you had taken delivery of storage, you would have had a truck pulling, if you had purchased these contracts, you would have had a truck pull up and deliver oil to your backyard. And people didn't want to do that. So they were actually paying people to take oil off their hands. So a little bit of anomaly there. But the longer term outlook for oil is still somewhat uncertain because we just don't have the demand side, and we have a tremendous amount of supply due to the technology and other things that have been brought to the energy space. Tim pointed out earlier some of the improvements in the rail sector. This slide here looks at trucking, and we also have some clients that are involved in trucking in different capacities, and some of them have actually been seeing really, really strong demand for several years and have been surprised how long this part of the cycle has been really continuing for them, you know, pleasantly surprised, but still somewhat dismayed. But you can see here again in March, this is a shorter term chart, only about a year's time. Well, I guess it is longer term, sorry about that, 5-year chart. But you can see in March, this is a conditions index. So above 0 is where we have positive conditions in the marketplace. Below 0 is where there's some negative activity going on. And you can see the drop off in March as we reacted again to all of these different market impacts in March. But subsequently, we've rebounded, and the outlook is extremely positive going forward for trucking. And that is a very strong positive economic indicator for that area of the industrial economy. Copper is another one that's typically used for industrial from a manufacturing input cost. And look at how copper has come back from that March sell-off. A very strong indicator of future business manufacturing activity, not just here in the US, but globally. Then lumber prices. So a short-term lumber, we talked about housing and how strong that was in the US, in different parts of the country, a little bit stronger than others. But I can tell you, you know, I was doing some home improvement projects earlier in the year, January, February time, you know, ran out to Menards and bought some lumber. I just went out about a month ago and I paid double what I paid in January, and that's what this chart is showing. Literally, prices for lumber have doubled from that $400 to $500 level to over $900 recently, and just so very strong indicator of the demand for lumber, the demand for things like housing, where lumber is a primary input, and thereby raising, you know, home prices too on new home building. Finally, we have gold. Gold is a little different animal in that many times people are looking at this as an inflation hedge and other things. In my experience, it's really more of a fear hedge or an uncertainty hedge. And you can see that uncertainty certainly entered into the markets, but we had already been climbing a little bit over the last year or so. In 2019, we had a little bit of a drop off, just like everything else in that March timeframe, when didn't really know how things were going to shake out. But since then, with some of the uncertainty continuing around COVID and how long this is going to last, you've seen that price of gold continue to move higher. So the next sort of item on the radar is the election, of course, and that's always sort of a wild card. Another black swan event that we get every 4 years is, how is this going to turn out? Who's going to win? And it's more than just the presidential election. Obviously, it impacts, you know, what's the outcome in the Senate and the House as well, and who is in control and what sort of economic policies that might get put in place as a result. And you can see on the right-hand side of this chart that economic policy uncertainty is elevated once again due to the election, and really will impact as well tax policy. Right now, we have the odds of a Biden victory a little bit ahead of a Trump victory. But in many respects, when you're anywhere near this sort of 50-50 type level, all bets are off and things can change. If you remember the last election, Hillary Clinton was predicted to be a winner well ahead of the actual election, and then Trump ended up pulling ahead and actually winning. This time around, it's a similar sort of look and feel. The difference here is, you may remember the old hanging Chad controversy in the Al Gore election attempt, and here we're going to have a lot of people doing absentee ballot, mail-in ballot voting, and if there are delays in counting those votes and seeing who is actually going to be a victor, that type of uncertainty may affect the at least near-term market reaction to the election when it comes. So with this, I will turn it over to Dan with some comments on how it might affect accounting and tax policies.
Thanks, Rob. So just want to dabble in or throw a little bit of the tax kind of landscape into this as we go into the presidential election. There's been a lot of press as far as what some of these differences might be. And I've really kind of broken it into two categories. One is the individual taxes and then the corporate taxes. These things, in my opinion, weave into the economy. And as a result, I kind of want you to understand, a little bit about them and what maybe is in the forefront, and then how do we maybe kind of plan or put some things to kind of watch and going forward. Individually, we're looking at, Trump's current tax structure is about 37% on the high side, and Biden would go back to the 39.6, which was really the Obama and Clinton tax rates. The impact on the economy of these things is more driven from the, does it take discretionary income out of people's pockets, and therefore, the goods and stuff like that go down in demand. And then, what kind of behavior changes does this create? Does it, people not so anxious to pick up income and look for different ways to generate cash flow and not have as much income impact? Another portion of the income of the individual tax rates is the capital gains rates, which will also feed into some behaviors. But they're looking at the capital gains rates under Biden's plan of going to ordinary rates, which would be 39.6%, whereas under the current tax structure, it's 20%. A dramatic change, and would change in some behaviors. I'm not sure that will necessarily come to fruition, but it's some level of that increase we could see. The other piece of this is the corporate taxes. The corporate taxes is not as dramatic. It's a 7% increase, but the reality of it is corporate taxes have a double tax component to it. So we have the corporate level paying the tax, and then in order to get those dividends out of the company, we pay another level of tax. And if that's our dividends or capital gain rates and they're back at ordinary levels, that starts changing people's behaviors and how they do things. Another element that's kind of important is the global element of this, and that's offshore intangible or wealth. So some businesses will create a subsidiary in another country, and then they'll retain those profits in that country to avoid U.S. taxation. Under the 2017 tax reform, they brought back and said, okay, well, we're going to want to tax some of that income. We're going to tax 10.5%. Biden's now saying, I'm going to raise that to 21%. So the question is whether that, forces companies to bring the money back and trigger the tax event, and that takes cash flow out of the ability of corporations and possibly affects the willingness to put some capital expenditures forward. It might affect or reduce somebody's dividend payouts that they receive. It really comes down to cash flow, and then the cash flow, if you reduce cash flow that a business can spit off to its investors, you reduce the value of the company. And we saw this in 2017 when the corporate tax rates went from 35% down to 21%. There was an increase in the stock market, and there was other effects in the stock market that created some increase, but a good part of it was the ability that there was more cash flow that was going to be available for an investor and allow them to spend on that. So I really put on, three basic categories that we now want to give you some planning ideas for. Next slide. And then we have the income deferral. So, you know, we could see the tax rates increase, and if the tax rates are going to increase in the future, we might want to say, okay, let's pick up as much income as we can in 2020 and then push, you know, if Trump were to be victorious, maybe we don't see the change and therefore we push that forward and continue to defer income. Dividend payouts, we saw this in, I can't remember what year, 2017 or 16, or where you had the big push of dividend payout because we thought we were going to have a capital or a dividend rate change. And so everybody was paying off a lot of dividends before the end of the year and then wouldn't pay them for a number of years after. So there's a lot of planning from that perspective, or things you could see. We also see that if the economy tightens and discretionary spending goes a little bit tighter, you know, then the government sectors might be more consistent, more reliable, stable, whereas the discretionary spending sectors might see some troubling times. Also, we'll see that the price point awareness needs to be kind of in the forefront of people's minds. You know, again, the discretionary spending goes tight. Is my price point right? And, you know, do I have the technology and innovation in my products to force people to make the purchase regardless of the price? And then cash reserves, you know, do we deploy them now? Do we deploy them later? And if we're in a low tax situation today, a deduction for purchasing equipment might not be as valuable as pushing it forward and getting that deduction in 2020 or after, but you might not also have the cash flow to do that. Another strategy would be the acquisition of targets. You know, in a year or more, right now the M&A market's pretty decent. It has been some COVID effect to it, meaning that prices have come down from the value people are willing to pay for them, but yet it's not to the point where I believe it's necessarily a buyer's market. And so maybe in a year or two, you might say, okay, let's hang on to that cash reserve and let's deploy in a year or two and look for some decent targets that may have struggled as a result of tightening of the belt. So those are some just general things I want to say on the tax side, and then how they kind of weave into the economy. Now I'd like to just kind of open it up and see what kind of questions we might have and see what we can do.
Yeah, so just as a reminder to everybody, and thank you, Dan, Tim, Rob, ton of great information there, a lot to soak in. As it's soaking into everybody's brain, if you think of questions, again, open up the chat box within Zoom, and I'll make sure that we get those questions asked and answered. A couple things that popped up that I wanted to bring up to you guys while those come in, and I see we've already had a few, is, you know, we talk about the leading indicators for businesses and kind of what you'd be looking at for each industry. And I took some time and went through the attendee list. We've got a lot of people on that are in commercial architecture and commercial construction. That's obviously an area that's been hit big. Tim and Rob, do you guys want to talk a little bit about what leading indicators you'd be looking at for that industry? And then maybe Dan, how you'd use that information to change your business decisions?
Rob, you want to start?
Sure, go for it, Tim.
I said, go ahead.
Oh.
So one of the things that we've seen as a result of COVID is obviously a little bit of a shift in employee behavior. I mean, our forecast is that you know, some of the people that have gone to a virtual environment, like you see me working from home, some of that may be permanent. And what we're seeing is this is certainly being factored into the pricing and plans on things like office space, the need for office space, renting office space. Companies that we've talked to, they've put off purchasing real estate or building new. So that would be the downside. But that changes, you know, that obviously makes the investment opportunity a little bit different for those types of companies that would benefit from the build out of work from home or remote type investments, like you know, technology companies, cloud technology companies, software services that can be applied more broadly. So those are some of the areas that we see investment opportunities directly as far as stock portfolios and elsewhere.
Yeah, I'll add to that is that I think this COVID has taken the technologies that basically work anywhere technologies and moved us maybe from the first inning to the third or the fourth inning. And I think that if you look at kind of surveys first, there's a pretty big insurance company here that surveyed their people. Over 78% of the people wanted to continue to work at home, either full-time or part-time. And 75% of that group felt that they were more productive in that environment. The difference is, and all the panelists from SVA can attest to this, is that we were shrinking our footprint for our own employees inside their cubes in their offices, making them smaller and smaller. And now what we're finding out, it's either going to be more offices or bigger spaces, more spread out. So I think that there's a little bit of that offset, but I do think it's an area that you're seeing strong growth in housing. And also I would watch the pendulum to see if there's been a flight to the cities, and what does the flight away from the cities look like? And one of the ways you can look at that is just look at where permits and where buildings going on, and you can see it in a bunch of different areas that it looks like this is starting to look a little bit like the 70s, where people are pushing out of the cities, looking for a little bit more space. I know that we have a bunch of veterinarians and people that are working that area also, and you're seeing, I think we talked a little bit about this as a group yesterday, the amount of people that want to have a pet, 33% increase of people that hadn't looked at it before. And in that group, a dog owner spends over $1,000 a year, and a cat owner spends over $800 a year on those animals for the comfort end. So I think that you could also see some of those areas see an interesting increase in opportunity.
Yeah, and I'll just add from the business element of taking that data, right? So we're seeing that, is there going to be a need for, more or less building construction and that type of thing? Is it, does the road and that type of infrastructure not need as much attention because there's less people on it and that type of thing? And part of my concern on this, and maybe because I'm old school, I just feel like, I could only work from home for so long and that type of thing. And what is it, will that statistic change? It's one of those things where it's like, it's great now, but a year from now, maybe it's not as attractive and so forth. So I think, with that being said, I think we want to stay on top of the technology and how technology is changing and how it's being used, but also the workspace environment. I mean, they said that in a virus, right, whether it's available in October, November, it's just going to take a long time to get into the population. And the reality is that the effectiveness of a virus isn't 100%. So we still have the issue of COVID, and whether that requires social distancing, whether it requires, a lot more attention to those types of things would be kind of where I'd be focusing some business activities on.
Yeah, I mean, I think this ties in. We got a question from Scott Spaulding that said, do you have any estimate of the economic impact on social unrest starting in May? And it's kind of combined with that, the COVID issue about space and where do you want to go. There's a professor from the College of Holy Cross, his name's Victor Matheson, and he did a study on the aftermath of the King killing in LA. And by his estimation, it cost $5 billion in 10 years before the economic impact of people being comfortable back in those areas. And so what I would say is areas like downtown Madison and downtown Minneapolis, it'll really depend on how soon people feel comfortable being back in those areas full time. And the quicker that happens, then the faster those areas can recover. He also compared the King LA to Hurricane Andrew, which was about the same time in Miami. And I was actually stationed at Homestead Air Force Base in Miami during when the hurricane wiped the base out. Also says how old I am too, in a way. But and he said that Miami bounced back a lot faster for two reasons. One, people were comfortable, and the Fed's government response to money putting towards that issue was much greater. So that those two combinations, the Fed being willing to do it and people being willing to go back, will really decide how some of these areas recover.
And we actually have seen some shift too, related to that social unrest and ongoing in some areas. And in addition to things like the impacts of hurricanes, the impacts of the wildfires in in the West Coast. I have a client who's out in San Francisco, and he said he's never seen anything like this, where a lot of their apartments in the downtown area of San Francisco and surrounding areas, they don't have air conditioning built in, yet they had a heat wave a couple weekends ago hit, and then they couldn't even open up their windows because there was so much smoke and stuff in the air. Similar to that, and some of the social unrest issues that we've seen in major metropolitan areas, we had been seeing a shift of many millennials and a lot of apartments being developed in those downtown areas, because a lot of millennials wanted to live downtown. They wanted the excitement, the restaurants and the things to do at night and so on. And then some of those exact areas where some of those really nice apartment buildings and things were being put up. And this is not just areas like Madison or Milwaukee or other places. I was reading a story, again, out in the Portland or Seattle areas where some of this is going on. Very, very nice apartment buildings that now they're having trouble getting new people to move in, because those were areas where demonstrations were going on, and people couldn't open up their windows because of tear gas, of all things. So it has certainly caused a shift, and what we're seeing is higher demand for now suburban real estate properties, houses outside the cities. And that was a very quick shift. I'm not sure how long it'll last, but that is a very recent shift that we have been seeing.
Yeah, and just one little added note on there. It wasn't that long ago that Boeing and McDonald's moved their headquarters to downtown inside the Loop, Chicago, so they could be more competitive on millennials and getting employees in, because that's where everybody wanted to live and work together. So I keep an eye out for major corporations. You're seeing some of that shift out of other corporations shifting out of California to Arizona or Texas for tax issues. So people will vote with their money. As Dan was saying, these valuations can make a big difference. If tax rates jump up, profits for, say, the S&P 500 might be flat. So the PE, the price to earnings or price to profits that people are willing to pay, it might not go up, or they might be steady or shrink. So, that tax piece has a big difference. And it also, again, the other part of it, which Dan pointed out, was that money that they could either give us profits, but a lot of them were starting to really increase their capital expenditures. They were investing in the business, and that's a big force multiplier too.
And that's actually thanks for bringing that up, Tim, because we did have a question come in about the effect of all this stuff on valuations. And I know, Dan, a couple of those acronyms I threw out earlier have to do with valuations. Do you want to talk about the effect, what you're seeing on the valuation side of things?
Yeah, so we've had a number of clients that had started some valuation or some M&A transactions as prior to COVID, and then COVID hit. Some transactions continue, but the buyers seem to want to do some kind of discounting as a result of the economic uncertainty around the COVID. So what we're seeing is the buyers are either looking for something that they believe they can buy at a lower cost, or two, they believe that there's potentially a tough obstacle to really get back to the growth that we've seen in the last couple of years, which a lot of the historical results are baked into our financials currently. So we're seeing that some activity on that front. We also seen the fact that if there's an increase in tax rates, right, then the cash flow available to investors goes away, and are they baking that into some of their buying strategies as well? So if you're interested in selling at this time, you got to kind of make sure that you're still going to get the right price and what you're basing it on, or you hang on to that business until a lot of these uncertainties maybe go away and you're able to capitalize on that. Part of the whole thing that I've watched from a valuation side is whether we have a V recovery or what we call a Nike swoosh. And as we saw in a lot of things, we have a V recovery currently. Whether that V recovery is sustainable or not, Tim and Rob can kind of comment on. But we also saw on the service side, we saw the Nike swoosh. And the thing with the Nike swoosh is that the slow, gradual recovery to prosperity again. So, those are things as, we're running our businesses, we got to be able to start planning for and looking at the indicators of what might be telling us whether we're going to drop back down and hit another V, or we're going to hit the V and then the swoosh back up, or whatever it might be. But Tim and Rob, maybe you could comment on what that means.
Yeah, I guess I'll start. One of the things that where you sit in Milwaukee and where we sit around, actually all of us in the Midwest, there's really a renaissance in this manufacturing area coming back to the US and really coming back to this area. So one of the big positives that I would remain is, remember, building stuff is still going crazy. I know that bikes are back ordered for 210 days if you want to get a bike. So it's not just pent up demand, it's pent up ability to do that. And again, remember with that, and Dan, I know you do a lot of work in the manufacturing area, that those are job multipliers. Those are things that produce more businesses, beyond that. But the longer this goes on in that service area, every day, your heart gets ripped apart as you see another restaurant or business that closes its doors permanently. And permanent job loss, there's some interesting things that happened after the Great Recession. How long that takes, that graph is still climbing. That permanent job loss is still climbing. That needs to top, and then when it starts to go down, that's, Dan, when, like you said, and Rob's talked about earlier, we'll be at that point where everybody will feel like we're kind of past that and we're in the sustainable recovery. Probably was about 2011, right, when everything really kind of bottomed and we moved out after the Great Recession. But it's a race to the vaccine. If you can tell me, A, can we get the vaccine, and then B, how many people are going to take it, will really drive, how much of that can we get back of that service part of a GDP.
Well, let's go there with that, actually, because we did have a question come in about the effect of the vaccine, and Rob, maybe that's something you can address. But there's been talk about a vaccine being available anywhere from 6 weeks from now to maybe the beginning of the year, middle of the first quarter, and then how long does it take to get that out in the out to the country? Rob, do you want to talk about the effect of kind of how that comes through the economy?
Well, I mean, I think we've already seen a good amount of that sort of being priced into the stock market reaction, since the sell-off in the March timeframe. You certainly see that with a wide variety of healthcare stocks or pharmaceutical stocks that might be working on some of the treatments and vaccines. So a lot of that was priced in, every time we saw a positive news event, those stocks reacted pretty quickly. And in some cases, it was very interesting to see that, it was priced in, and then just a few weeks later, it was almost as though some investors maybe were disappointed that it wasn't continuing to move in such a rapid fashion, and some of those stocks, gave some of those gains right back. So a lot of uncertainty still on the timing, Lee. Everybody wants it yesterday, but we just don't know when, we're actually going to have the actual results that show that this is truly an effective treatment. And then after that, we have to get into the point of how are we going to manufacture and distribute that in an equitable fashion. Really, this is not just a U.S. event, this is a global event, right? So how do we get it to where it needs to be in the right ways? And just simply, how do we create enough of it? And how long is that going to take? So there is a longer timeline than just a few weeks, no matter what. So the more active agents that can get created, the better. And so we'll see. But right now, we don't have any. So we're still a good ways away, in my opinion, on really having a vaccine cure. Typically, the earliest I've seen is mid to late next year in really having, a distributed vaccine available. And some of them, it's even a couple of years.
Yeah, okay. All right, just real quick, I wanted to ask one more question because you guys touched on veterinarians. We have a lot of vets on the call right now. We talked about commercial construction. We talked about housing, talked about manufacturing. We have several leaders of nonprofits on right now. What are some, just real quick, what are some things that you'd be looking at if you were a leader of a nonprofit? What would be those things that you'd be looking at to see that, hey, things are trending good for us?
Well, I think one of the things that you're seeing, if you remember back to that savings rate that was up to 35 coming back to 17. So I think is that, and looking for consumer confidence to increase. The other part of it is gifting tends to be very personal. So as you can get to places where even if it's mass that you can, get together. I know that I'm on a couple of boards like everybody else on this panel, and it's hard. It's been hard for those groups. But the other part of it was some of these tax changes that are coming out. You might want to have charitable giving as a key part of your planning in November and December also.
Okay, thank you. All right, Dan, Rob, Tim, thank you so much. Great information. Just really crammed in a lot of information in a short period of time. And I just want to say, as we wrap up, I'd like to let all the attendees know that SVA has created a resource page, which is svaaccountants.com/back, where the recording of this webinar will be located, as well as additional information and updates on getting back to business. Our next webinar will be on October 7th, and the topic will be different times equal new risks, understanding your current security risks. For you nonprofits that are on, we just talked about you. The next nonprofit business briefing is October 22nd and is titled Best Practices, Lessons Learned, and Planning Ahead for 2021. I'd like to remind all of you that the SVA team is only a phone call or an email away, or a Zoom call. So if you're a client, reach out to your SVA professional if you have questions. If you're not currently an SVA client, please feel free to reach out to me. I can get you the answers or the help that you need. Again, we are here to help. Thank you again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar in just a few weeks.